Welcome to Biz Wire. The BRICS Summit of Developing Countries has concluded with 2 headline agreements and plenty of smaller items that will come out over time. The first of which, as we've detailed before, is the establishment of a development bank similar in mission to the World Bank and IMF that will be used to fund infrastructure projects in poor countries. Later in the second half of our show, we'll also look at a $100 billion currency pool that will help cushion against any shocks in the global economy. As the euro crisis continues and the West in general shows little signs of growth, the World Bank says that global economic growth is increasingly dependent on the BRICS countries, which account for 27% of global purchasing power and 45% of the world's workforce. Several other agreements were expected to be signed during the summit, including in defense, education, energy, science and technology, agriculture, and transportation. With Chinese President Xi Jinping's first trip abroad as head of state, all week in Economic Insight, we've been looking at how China's role in global affairs affects its economy. And now we want to look at how China and another BRICS country, Brazil, interact. Earlier this week, the 2 emerging powers agreed to swap up to the equivalent of $30 billion in each other's currencies if need be, so that their fast-growing commercial ties will not suffer if a new banking crisis causes dollar trade finance to dry up. It's not a landmark deal, though, as trade will still likely be settled in dollars, but does show the 2 countries have a good working relationship and is a sign of more cooperation on the horizon. Brazilian Economic Minister Guido Mantega said the pact would act as a buffer against turbulence in international financial markets that are dominated by the U.S. dollar. Brazilian officials have said they hope to have the trade and currency deal operating in the second half of this year. Mantega said that if there were shocks to the global financial market with credit running short, Brazil would have credit from China, their biggest international partner, so trade would not be interrupted. Brazil's vast mineral resources and agricultural products have helped fuel China's industrial growth and feed its people, while the returns have helped bring a new era of prosperity to the Latin American giant. Bilateral trade totaled around $75 billion last year. Of Brazil's $41 billion of exports to China, iron ore accounted for about 34%, while soy and soy products made up 29%, and crude oil about 12%. Electronics, machinery, and manufactured goods figured heavily in Brazil's $34 billion of imports from China. On Wednesday, we looked at how other developing countries are adopting China's growth model, and Brazil is no different. Finance Minister Mantega said Brazil is already seeing signs of economic recovery after dismal growth in 2012, but still needs to follow China's example and invest in infrastructure to unleash its potential growth. In the past decade, trade between the 2 emerging powers expanded over 1,000% and shows no signs of decline. Jojo Wei, a researcher with the Chinese Academy of Social Sciences, said that in 2011, bilateral trade between China and Brazil surpassed that between China and Russia, making them the biggest partners within BRICS. In 2009, China replaced the United States as Brazil's largest trading partner. Even more so than Africa, which gets a lot of press, Latin America has become a major focus of Beijing's drive for commodities. A study last year by Enrique Dussel-Peters, a professor at the National Autonomous University of Mexico, found that the region has been the leading destination for Chinese foreign direct investment, mostly for raw materials and by big state-run companies such as Chinalco and CNOOC. Since the 2008 financial crisis, China has also become the main lender to the region. In 2010, it provided $37 billion in loans, more than the World Bank, Inter-American Bank, and the U.S. Import-Export Bank combined. Most of this has gone to 4 primary exporters, Venezuela, Brazil, Argentina, and Ecuador, for mining or transport infrastructure. Now, some may lament the environmental consequences, but the economic benefits have been enormous. Trade between China and Latin America was just $10 billion in the year 2000 and is now well above $250 billion. What some describe as the lopsided nature of Chinese-Latin American trade is also questioned because while it is good in terms of GDP, it has not been so beneficial in terms of development or for the environment. Brazilian commodity suppliers like iron ore giant Vale appreciate China's demand, while manufacturers complain of a flood of cheap Chinese imports that undermine their competitiveness. Pollution and heavy resource extraction are not new to Latin America, which has been carved up and exploited since the arrival of Christopher Columbus and Vasco da Gama, and nor are the Chinese state firms necessarily any worse than private multinationals, but demand from China is an additional source of pressure on an already fragile situation.